Hello, my name is Jim Wade, and I'm a tax attorney here in Portland, Maine, and I help taxpayers in trouble. And what I'm trying to do is a series of videos on how the IRS collects taxes. Today is just going to be a basic overview, but future videos are going to go into depth on what you need to know if you owe the IRS back taxes, how you can resolve your debt. Um, in some cases, you may have to pay it all, but over time, maybe there's potential for penalty abatement, offer and compromise, settle it for less than the full amount. We're going to talk all about that, but it's always helpful to start at the beginning. And this video is going to be very short, but it's just going to give you the basics of how the IRS collects taxes. So let's get started. All right. Now, when the IRS, well, let me just wait. The IRS is not sort of free to collect taxes whenever it wants. There is a very formal process that it needs to follow before it can do a wage garnishment, a bank levy, or filing a tax lien. And here I've kind of done the best I can in summarizing it on all in one slide. So the first thing is obviously you file a tax return. And we're going to assume that you filed it and there's a balance due. Or in some cases, if you've never filed a return at all, the IRS has the authority, if there's information in its system that says you do have potential taxable income, it'll file what they call a substitute for return. And that'll act as a tax return and allow it to assess taxes against you. So whether you file a return or the IRS does it on your behalf, the IRS will record an assessment in its records. An assessment isn't good, isn't bad. It just means there is a balance in the account that's due. If you have withholdings or estimated taxes and that offsets the assessment, you may even get a refund. But if you have back taxes, what ends up happening is either your withholdings and estimates don't cover the tax or you haven't paid anything in at all. Anyway, there's a balance due. The IRS will send out a notice and demand for payment. And that's important because the IRS can do nothing until it sends out that notice. If you don't pay the tax upon receiving the notice and demand for payment, automatically by law, a statutory lien arises. It's also called the silent lien. The idea is that automatically there is a lien against your property and the IRS has a claim. It doesn't have to go through the formal process like a normal creditor would. So if you've got a credit card debt, the credit card company would need to take you to court, uh, prevail, get a judgment from the court, and then afterwards it could take steps to collect. Not so with the IRS. As long as notice and demand for payment has been sent out, a lien arises, and now it has a potential claim against your property. If the tax debt is more than $10,000, the IRS will take it a further step and they'll file what they call a notice of federal tax lien. This notice of federal tax lien tells everyone, it's a public record, so it tells everyone that you owe a tax debt. So now if anyone's going to lend you money or if someone's going to buy your property, they know the IRS has a claim against it. Or if, they're going to lend you money, potentially the IRS has equal claim to the property. So they just puts creditors on notice. Sort of at the same time the IRS is filing this tax lien, the IRS will start the process to take it to another step further where they're actually going to seize your property. A tax lien is a passive collection device. It just sort of sits there like a blanket over your property. And if you try to sell something, if creditors have notice of the IRS claim, the IRS is going to have to be dealt with first before the property can be transferred. This almost always happens when you're selling your home. It happens less frequently with other types of assets like a car. A levy, however, is a very aggressive means of collection. It allows the IRS to do wage garnishment or seize funds in your bank account. Very rarely does this happen, but the IRS could foreclose on your home or seize your retirement funds. Those last two are very rare, but they can do it. To get to that point, the IRS sends out a series of notices increasingly demanding payment until you reach the last one, and that is the final notice of intent to levy. The IRS has kind of tweaked it now, so it won't say final notice of intent to levy anymore. It used to, but you have to read it. If you see on the notice where it says, okay, you've got 30 days to pay or the IRS can seize your property. Oh, by the way, you have a right to make a collection appeal. That should key you in that you've got a final notice of intent to levy. You can also look to the upper right corner of the letter from the IRS. If you see a CP 90 or CP 297, I believe, that also should key you in that you've got a final notice of intent to levy. If you're absolutely unclear, if you go to irs.gov, type in IRS notices, there's a page there where you can type in the CP number and it'll tell you what it means. So be very careful. If you get that final notice of intent to levy, you've got to act. So within 30 days, you've got to pay the tax or you got to file a collection appeal. Otherwise, 30 days passes, the IRS can levy your property. And furthermore, this is really important for tax attorneys or other tax professionals who are helping people with IRS problems, is you lose the right to have not only an appeal to the IRS, but an appeal to tax court. There's like a two levels of appeal. And the idea is it says appeal. It's not like a court case where you sort of lost and you have a chance to sort of have it reviewed. It just merely means that the IRS, when they're trying to levy your property, you're saying, okay, I appeal the IRS intent to levy. I think there's another way that we could handle this without you seizing my property. And once you get to IRS appeals, you don't get, if you don't do it within the 30 days, this request for an appeal, you lose the right to go to tax court if appeals doesn't agree with you. You can, if you file for an appeal after the 30 days, I think it's up to a year from the date on the final notice, you can request an equivalent hearing. You don't get the same right to go to tax court, and the IRS doesn't have to cease collections. Whereas if you did it within the 30 days, the IRS would have to stop collections. Now, my understanding, I haven't personally experienced this, but my understanding is even if you do request an equivalent hearing, you don't get a further right to appeal, but the IRS generally will hold off on seizing any of your assets. So that's a good thing. I think the IRS knows that, hey, we would rather someone try to work with us than seize the property while they're asking for the IRS to review the collection matter. It's bad press. So anyways, if you do nothing, 30 days passes, the IRS can seize your assets. Normally, it's going to be a bank levy or a wage garnishment, and it's going to hurt. The IRS wants it to hurt because they want you to come to the table and resolve your back taxes. Like I said, this is just first in the series. My next video is going to be about the 3 things you need to know when resolving your back taxes. And I'm going to talk to you about, okay, now you've got this final notice of intent to levy. What are the 3 things you need to know to resolve your back taxes? So if you have a question about what I've talked about today, or you have just general questions about IRS tax resolution, you can contact me at my email below or by phone number. Please like, dislike, doesn't matter to me. Feedback is always helpful. And if you're so inclined, hit subscribe. Thank you so much for listening. Have a wonderful day.